Now, the reason why we're here is Bullock Pen requested the Kentucky Rural Water Association provide an independent comparative financial analysis of these alternatives to supply drinking water, either through a new treatment plant or through a new pipeline. Two words that I want you to focus on there. One is independent. We don't have a stake in the results. We don't have our thumb on the scale. We don't advocate for a particular cause. And the other is financial. So with that, we're only looking at the financial impact of these two project alternatives. We've done no assessment of the either option's technical aspects, engineering aspects, or their operational feasibility. And so with that, the projections and the conclusions that we've prepared are based on what's currently available information, and this is intended for comparative purposes only. And so with that, what we have done is computed the revenue requirements that are going to be needed to recover the operating expenses, the debt service and debt service coverage, and the depreciation expenses for each alternative. This analysis provides a model, and that's the thing I want you to keep in mind. This is the model that we're delivering of what are the operating expenses and the capital expenses in order to project the impact on water rates over the next 40 years for each alternative. Now, this model is intended to be usable, to be updated to reflect changes in the key assumptions. We'll come back to that at the end. So with that, let's talk about what constitutes a standard methodology for evaluating financial costs of project alternatives. This is something that I have done repeatedly over the last 44 years. So the way we do it is a standard methodology. The first is to identify the annual cost for all aspects of each alternative. Then you select a relevant planning horizon. Typically, on long-lived assets, I typically look at 20 to 25 years, but this client specified that they wanted a 40-year analysis. Some people have asked, do we need a 50-year analysis? And the fact of the matter is, there's nothing new that you would discover stretching it out over 50 years that you don't already know after 40 years. Step 3, we take and prepare a forecast of those annual costs over the planning horizon. Then, and this is what may be a little bit unusual, but it's fairly simple. We select an appropriate discount rate to bring that future stream of costs back to a present value. So basically, you remember that expression, a bird in the hand is worth two in a bush? Well, that's how you discount that 2 birds in the future is equal to 1 bird today. This is the methodology that you use that. And then we compute and compare the present value of each project alternative's costs. Okay, so with that, as we go to get started, there are some questions that we begin with to consider, to answer the larger question, what is the cost over the next 40 years for the build plant alternative versus the build pipeline alternative? So there's a number of questions that we had to ask ourselves. First question is, how much water will the district customers demand? There's 2 essential drivers on that affect demand. One of them is growth, and the other one is conservation. Is how many more customers that you're going to be using, or that you're going to be serving, versus how much they're going to use per household. The second question is surprisingly, excruciatingly complex, which is how much customer demand, or how will the customer demand be met by each alternative? Third is how much new operations and maintenance expenses, you may hear me refer to that as O&M expenses, how much O&M expenses will be, how much new O&M expenses will each alternative require? Breaking it out into 3 parts. Water purchases expenses, source of supply and water treatment expenses, and transmission expenses. When I talk about transmission expenses, I'm talking about moving it from the source of supply to the storage tanks to the customers, or to the neighborhoods of the customers. And then question number 4 is which of our current expenses go away with each alternative? So if you build a new plant, the costs associated with the new plant come online, the costs associated with the old plant go away, as an example. Question number 5, how much additional depreciation expense will be incurred with each alternative? We're going to talk about depreciation more in detail in a few minutes. Question number 6, how much new debt service will each alternative require? Number 7, how will those expenses change over time? Now that's one of the items that you can anticipate that you're going to want to look at in terms of assumptions for the model. How will those expenses change over time? Number 8 is what will minimum bills and typical household bills be over time for each alternative? Okay, we know what the minimum bills are now, we know what the typical household bills are right now. What will that be over the next 40 years? And then finally, the last question, because this is where I see all those other items come together, is what is the present value of the future stream of revenue requirements for each alternative? So with that, we're going to go and talk about the demand inputs. This is going to be singularly the hairiest part of the presentation. I ask you to be patient with me, follow along, it'll make sense. It's just, this is where the complexity of the model takes place. Okay, so with this model that I have has a series, if you're familiar with Microsoft Excel, this has a series of sheets within the spreadsheet model, and each of those sheets represents a particular table. Table A, the first thing we had to nail down were the demand inputs. Now, Table A calculates the amount of water purchased, or what amount of water produced, and the amount of water purchased over the next 40 years for the build plant alternative and for the build pipeline alternative in consideration of these factors. First of all, we start out, what is the initial water sales and water loss demand on average days and peak days, okay? So let's break that down. Water sales is what is going to end up starting at the beginning of the pipeline and going to a customer. Water loss demand starts at the beginning of the pipeline and gets lost along the way to the customer. Mm-hmm. And then we talk about average days, which is essentially take the annual usage and divide it by 365, but then not all days are the same. Here in Kentucky, we typically see peak day demand during the summertime for more outdoor usages. Okay. Then we take, once we've got the initial sales and water loss, then we say, what are the growth rates going to be? how fast will water sales demand grow? How fast will water loss grow? We assume that each of the project alternatives will be constructed for use by January 1st, 2028. That's merely an assumption. That doesn't talk about constructability and all that. That can be moved forward, it can be moved backwards. It's just a place to drive a stake in the ground and say, let's assume each alternative can be ready to go by January 1st, 2028, essentially just over 2 years from now. We also, right now, Bullock Pen Water District has, I think, 3 minimum purchase contracts. We made the assumption that those minimum annual purchase contracts would remain intact. That is just merely an assumption. That can be changed in the model as well. We'll talk more about that later on. Then we look at each of the alternatives, or I'm sorry, the treatment alternative. The treatment alternative is subject to normal daily limits as well as curtailed withdrawal limits. I think you all are already familiar with that. We'll touch on that briefly coming up, but you know what's going on there. So with that, we then go in and say, what are the key assumptions? We have the normal withdrawal daily limit and the curtailed withdrawal daily limit. It's my understanding that the Department of Fish and Wildlife tentatively agreed in 2021 to a maximum of those maxims that you see there. No, it's my understanding that no executed written document evidences this agreement, and that earlier this year, the district has discussed with Fish and Wildlife the possibility of an increase in that maximum withdrawal rate and the curtailed rate, but there's no change on that. So the assumptions that we went with are the ones there at the top. Okay. Next set of assumptions is what was the initial initial water sales demand, which was 393 million gallons per year, and the initial water loss demand was 143 million gallons. Now that could be anything from leakage to flushing or whatever, but so that the total water demand that needs to start at the front end of the system is 536 million gallons. And then we assume a water sales demand growth rate of 2.5% per year and a water loss demand growth rate of 0% per year. Let's break those things down. This part of Kentucky is a very dynamic and growing area. But 2.5% represents the reality of where it's at. Is 2.5% sustainable over 40 years? Don't know. That's to be decided upon by the policymakers, but right now there's no reason why it couldn't. It's just that areas typically you don't see that sustained over 40 years. The water loss demand growth rate I have at 0. And what I'm saying there is the things that cause water loss right now are not explicitly tied to the source of supply. The flushing that's going to take place is likely still going to take place. The leaks that take place are still going to take place. It's just not a function of the source of supply. Okay. Now let's get down into the weeds. I assume, based off of my analysis of your all's usage for the last 20 years, that your peak day is about 15% above your average day. So that means that the number of days, also that the number of weeks that you're experiencing peak demand is 13. That's essentially like June, July, August, or July, August, September. It's a quarter of the year you're at peak demand. That means 75% of the year is at non-peak demand. Then looking at the nature of the lake, historically, that the number of weeks that you would have a curtailed withdrawal is 9.4 weeks per year, which means about 18% of the year you'd be limited to the curtailed withdrawal rate, and then that essentially 82% of the year you would be operating where your demand is within the uncurtailed withdrawal rate. Okay. Now, this is the marching through the model, through the demand portion of the model, because we got to get this right before we can get everything else. So let's go through the steps real quick. Step one is to set the demand and supply parameters, which we just talked about. Identify the projected water demand. Identify what water will be purchased and what water will be produced until the new project is in service. Okay? Because remember, we're going to be under existing assets in 2026 and 2027. Then identify what is the minimum water purchase after the new project starts. Identify the peak season demand subject to normal daily withdrawal limits. Identify the non-peak season demand subject to normal daily withdrawal limits. Add up the purchases and add up the production subject to the curtailed limit. And then identify what production was subject to that curtailed daily limit. Then steps 9 and 10 are compute the final totals for the build plant alternative, compute the final totals for the build pipeline alternative. I'm going to stop and ask my boss for a Bucky's mint. Okay? So essentially what we had to do is say, answer two questions. How much water is going to be demanded versus how's the water going to be supplied versus the mix. Thank you. Childhood asthma comes back about once or twice a year. So we had to figure out how much water is going to be demanded, how that demand is going to be met. Okay, so the results of that is right now, the district currently produces about 30% of what is delivered into the system and purchases about 70%. Okay, right now, where we're at 30% produced, 70% purchased. Under the plant alternative, the district will initially produce just over 60% of the water it sells. Now notice, when we talk about the plant option, the purchase option is, or the purchase aspect of the system is still going to be very active. And as demand increases, and as the production meets the daily limits, the district will produce a decreasing portion of the water it sells till it settles out at about 40%. Okay? Under the pipeline alternative, the district purchases 100% of the water it sells. Okay? Now, let's look at this graph. The top of the graph is the annual water demand. And what you see is it starts out at just north of 500 million gallons and ends up right at about 1,200 million gallons. What you'll see down at the bottom is gray bars that are flat across the bottom, and that is the water loss demand. The purple bars is the water sales demand. Okay? Now, under the build plant alternative, what you'll see is we start out in year 1 and year 2 with the capacity of the existing plant. In year 3, we have the capacity of the new plant come online. And you can see that it continues to grow until we reach, gosh, that's around 2040, 2042, something like that. You will reach the limit of how much the lake can produce, and everything after that has to be purchased. Okay? That's why the blue goes flat for plant production, green continues to grow. Now, under the build pipeline alternative, you can see that the plant continues to produce for 2 years, and then after that, everything is purchased through the pipeline. Okay? You have to get this part of the model right for the rest of the model to be usable. Okay? So now we start off with what I call the financial base, which the folks that typically deal with the Public Service Commission would talk about it in terms of what's called the test year, which is what does it cost you to do things right now? And so we used the data from 2024 as the test year, and then projected 1 year to serve as the basis, or as the base, to then take it out 40 years. And I got that data from their annual report that they filed with the PSC. Then I go through and look at the assumptions. And I'm going to sit down because my back hurts. Right now, I'm assuming that the district and its suppliers will continue to sell water at their currently approved tariff rates during the interim until the new project is built. You follow? That everybody's rates for 2026 and 2027 will stay where they are. The water sales demand will increase 2.5% annually, and that additional demand is met by additional production. And that expenses other than water purchases increase by 3% annually. That's essentially, the shorthand version of that would be, we're assuming a 3% inflation rate over the history, which is a fairly reasonable number if you look back over time. Inflation has been very noisy since 2020, but before that, it's been very stable for, probably 25 years before that. Okay. Now, next we go and look at we've got what the water demand is going to be. We got what the base of revenues and expenses are going to be. Let's start looking at the financial plan inputs. So we start off with a whole series of assumptions. One is how much cash are they starting this project with? And I use the cash from the end of 2024. What's O&M going to be increased at? 3%. Capital inflation. Construction costs for the last several years have been going up faster than the traditional CPI. That is, pipes, pumps, concrete, construction labor, all of that is going up faster than O&M is. That's not unusual. If you look at CPI as a market basket, there's some things in that market basket that the price has gone down from year to year, and that would be things like toys and computer chips. Those prices have been driven down by foreign manufacturing. Other things, like, for example, the cost of retirement plans, those have gone up faster than the average. And if you look at the things that typically make up the O&M, which is labor, materials, contractual services, things like that, electricity and chemicals, those are typically going up at 3%, but capital construction costs more like 4%. I'm assuming that they're going to want to maintain an operating cash reserve equal to 25% of their O&M expenses. Let's talk about that real quick. When you're running a water utility, there's always the possibility that something's going to come along that prevents you from doing billing and collecting. That would be, for example, if you have a flood or a tornado come through the community, and you're going to be so busy trying to get the system back up and running, and you're going to have trash out over top of the meter vaults and all that, that you're going to have to last some amount of time without being able to bill and collect. That's why we recommend at least that you maintain an operating reserve of at least 25%. Next item is grant funds. We're assuming that either alternative of these projects is going to be entirely funded from debt, and that we won't see any grant funds. We have seen historic record amounts of grant funds over the last 5 years. I believe that for purposes of this project, that pipeline, that source of grant funds may be just simply unavailable. So since we're going to have to borrow the money, we have to make assumptions on the debt. Normally, you like to match the term of the debt with the life of the asset. However, we're going to be building assets that have, 40, 50, 60-year lives, and most folks don't like to issue debt or borrow for more than 30 years. So I'm assuming that we'd see 30-year debt at a 4% increase interest rate, that the debt service coverage, which is borrowers require not only that you pay the debt service, but that you also have some room to spare, that your revenues in excess of expenses, including debt service, your revenues must be 20% in excess of your debt service. That when you borrow the money at 4%, that as you use it, until you use it, you can reinvest it at 2%. I'm assuming that the new treatment plant would cost just under $20 million. That's from an opinion of probable cost from the district's engineers, that would be financed by borrowed funds in 2026 and 2027, and that the plant would be composed of two sets of assets. One would be structures and improvements, and the other would be the equipment that resides within the structures and improvements. And that would be about 75% structures, 25% equipment. Now, and that the new pipeline would cost about 18 million, just north of 18 million. Again, would be financed by borrowed funds in 2026 and 2027, that the new pipeline size would have a 12-inch diameter, and the new pipeline length would be 60,000 linear feet. Again, this is a key assumption that has to be validated. We'll talk more about that here in a minute. Okay, next is to take all those assumptions that we've made and turn that into a capital improvement program and then index that program for inflation. And so with that, tables D and E identify the timing of the capital improvements using the opinion of probable project costs for each alternative, and then indexes the project costs for inflation. So our assumptions are the construction estimate would be based upon, that was based upon 2026 costs. Construction begins January 1st of 2026. You know that's not going to happen, but we had at the time when we were working on this fall, we had to drive a stake in the ground. And then production would begin January 1st of 2028. And that all assets would be replaced after the end of their useful life or their engineering design. And that we're looking at that the plant structures and improvements, which made up 70% of the project, would last 37 and a half years. So if we use a 40-year model, we build them, and then 37 and a half years out, we have to replace them. Then the plant equipment, which was 30% of the project, has a 27 and a half year life. Now, again, these lives that I selected for the model were based off of what the Kentucky Public Service Commission typically allows for in their rates. That we would have to look to the engineers to say, what's your design life? Because these are just merely averages that they use. So again, structures and improvements, 37 and a half years, plant equipment, 27 and a half years, and pipeline, 62 and a half years. And then now that we've got the, what our capital improvement program is going to be, then we set in what are the useful lives and the depreciation. So this breaks that out, and then we also have to include new depreciation expenses as those assets are replaced. So if you look at it, the green line, the one at the bottom, is you can see that we have the new depreciation come online. The reason it's lower is because it has a longer design life. So you have a smaller number because you've got a larger denominator. In the plant alternative, you see it jumps up, and then out at about 37 and a half years, or something like that, it drops down and then pops back, or I'm sorry, 27 and a half years, you can see it drops down and pops back up. That is where you put the new assets online, and then you replace them out. And the reason it pops up like that is because you're replacing it not at current day dollar figures, but at future year dollar figures. Okay. So now then we look at water purchase costs. So table H identifies what's the annual water purchase cost for each of the alternatives. We're assuming the water supplier rate increase, annual rate increase, is going to be 3%. This is a key number. This is basically, if you're buying water from other people, what's their annual rate increase is going to be. We don't know, they don't know, they can't commit, but we have to pick a number. 3% is a good, reasonable, safe number, I believe. And then we go through and look at what would the new water purchase rate be. And the number we used is $3.68 per 1,000 gallons. The thing that's key to keep in mind is that there's not a contract in place at this time between Bullock Pen Water District and the Boone Florence Water Commission to purchase water at that rate. We are assuming that the new water would be purchased at that rate. Now, if we have a new plant, as we said, we're still going to need to purchase water. And so what I use there is that future water purchases would be at the weighted average of the rates of the existing suppliers. And right now, the weighted average of your existing suppliers is $4.18 per thousand gallons. And so with that, here is a graph of your annual water purchase cost. The blue line is the plant alternative, so that you see your water purchases go down immediately, and then they go back up over time. And with the pipeline alternative, as soon as you shut the plant down, your water purchases jump up and then continue over time. So that's the graph of the annual water purchase cost. Now let's look at, we've looked at water purchase costs, let's look at water production costs. This table identifies the cost for each project alternatives. Now, water production costs are composed of chemicals, electricity, labor, materials, and contractual services. And that cost per thousand gallon produced by the new treatment plant will be higher than the existing treatment plant because you're not getting the same treatment result. They plan to, if they go that route, they plan to have within that a granular activated carbon process within that treatment plant. So with that, we have gotten an estimate from them on what that cost for the new treatment plant is going to be. And note that there's no water production cost for the pipeline alternative beginning 2 years from now. So with that, you can see under the pipeline alternative, it continues out for 2 years and it drops to 0. And for the plant alternative, it continues for 2 years and then jumps and continues over time. So now we've looked at water supply costs, water treatment costs. Now let's talk about the cost of moving the water, transmission and distribution costs. Okay, this table identifies those annual costs for each project alternatives. The new transmission and distribution costs, which would be labor, material, and contractual services incurred by the new pipeline, are assumed to be proportional to the cost per inch mile for the existing system. Let me chase a rabbit for a second. When I moved to Louisiana, I drove out into the Cajun part of the state and pulled into a barber shop and asked for a haircut. And the lady looked at me in heavy accented Cajun English and she said, "Mister, I know you're speaking English, but I don't understand a word you just said." Okay, so let's focus on the word proportional. The cost of the new pipeline are assumed to be proportional to the existing system. Now, you might ask, well, why would it be proportional? And that is, it's a brand new pipeline. Well, you're still going to have to check for leaks. Since this pipeline is going to be so important, you're going to have to spend money to go out and check for leaks. You're going to have to fix leaks. Sometimes there's water main breaks. Sometimes contractors drill through it, and disrupt it. All sorts of things. And we're assuming that it's going to be proportional. Well, again, this is big pipe, and much of a Bullock Pen system is smaller pipe. And so we use a computation that's used by the Public Service Commission that kind of creates their attempt at apples to apples. So that if you have a 3-inch pipe and 2 miles, that's 6-inch miles. Where if you have a 12-inch pipe and 2 miles, that's 24-inch miles. So we use inch miles to try to compare apples to apples. And again, just as there was no treatment cost for the pipeline alternative, there's no additional transmission distribution cost for the plant alternative. And so with that, we show you what the annual transmission distribution cost is. You can see not a whole lot of difference there. Because frankly, a pipeline system is a relatively passive system. you're not having to do a lot with it, so there's not a lot of costs involved. Next, we've talked about source of supply, treatment, transmission, distribution. Now let's talk about what it costs to borrow the money to build the assets. Okay, this identifies the current debt service that you currently have, plus the debt service that you're going to be adding for each of the alternatives. This system does not have a lot of debt, and most of it gets paid off in the next few years. But we gotta say, include all of it in there. And so with that, you can see you add the new debt service, half of it in 2026, half of it in 2027, it goes online. And then as you pay off your existing debt, you can see then it goes flat. And you can see the pipeline alternative goes to zero, but the plant alternative doesn't, because you're going to have to borrow money to replace some of the plant equipment. Now, table L computes the revenue requirements and the rate increases over time. Then table M then creates what's called a pro forma income statement, which is your schedule of revenues and expenses. And we map that out each year for the next 40 years. From that, we take and create how much cash is generated from operations, because we've talked about you're going to have revenues in excess of expenses. How much cash is going to be generated from operations? And that's basically, it takes your net operating income, adds back in your depreciation, because that's a non-cash expense, and subtracts off the debt service, which is a cash expense, but it's not an operating expense. So that's how you get from net operating income to cash generated from operations. Then you have a financial plan for funding the capital improvements. That's typically called, in shorthand, that's typically called a sources and uses of capital funds. A financial plan shows, here's your sources of capital funds, here's your uses of capital funds. And so each year over the next 40 years, we start off with a beginning cash balance, add in the cash generated from operations, add in any new borrowed funds, and subtract off any capital improvements that we make. That gives us our ending cash balance for that year. String that in 40 years. Then we would say, okay, in order to cover all this, we're going to have rate increases. What are the rate increases going to be? And we did that in terms of how does that affect the minimum monthly bill? How does it affect the typical household average bill? And so what you can see is that the water bills jump up under either alternative over the next 2 years, and that's essentially to pay for the new debt. And then they track each other very, very closely, and then you start seeing a little bit of noise in the system due to the different inputs. But as you can see, that with that, under these assumptions, the water bills that are $30 now are going to be jumped to just under $40, but then stay that way for a long time. This is where the growth factor comes in, because revenue that you get from new customers is revenue that you don't have to get from existing customers. The thing about the water business is the water business is a high fixed cost, low variable cost business. Okay, so somewhere between 80 and 90% of the cost of a water utility are fixed. Even the labor, you don't use additional labor just because you're selling additional water. So about 80 or 90% of your expenses are fixed, only 10 or 20% are variable. But on the revenue side, only about 30% of your revenues are fixed, and 70% of your revenues are variable. And so as you add new customers, you can absorb any increases, inflationary increases in expenses. So again, that was the monthly minimum bill. The monthly average bill jumps from being around $45 to somewhere between $60 and $70 over the next 40 years, based on the assumptions. And I'm assuming 3,500 gallons of water for a residential customer. When I typically talk about water demand for a household, I assume that the water demand is going to be about 50 gallons per person per day. So a one-person household would use about 1,500 gallons of water a day, 1,500 gallons of water a month. 50 times 30. A two-person household would be 50 times 2 times 30, which would be 3,000. Most households have more than 2 and less than 3 people in it, so that's what we get for 3,500 gallons a month. Now we can start getting in towards the results, which is to take a look at the present value analysis of the results. Again, this is a reminder, I've talked about this before. The standard methodology is to identify the annual cost for each alternative, select a planning horizon, in this case it's 40 years, forecast the annual cost over those 40 years, select a discount rate to bring those back to the present value, then compute and compare the present value for each project alternative. And what I did here, you can see there's 5 sets of graphs there. The first graph is using 0% as a discount rate. So essentially what that is the total amount of cash flow over the next 40 years. For the plant alternative is $453 million, and for the pipeline alternative, it's $455 million. Okay, then you see 3 alternatives using a discount rate of 4, 4.5%, 5, 5.5%. I have been advocating using a 4%, but it was very simple to show what are the other alternatives if you used a higher discount rate. Okay, so now we've talked about using all of the expenses. Let's take a look and say, because most analysis that I typically do when I do this for the private sector, I don't include depreciation because they don't have to recover depreciation in the private sector, but in the public sector, the Public Service Commission requires that water districts recover depreciation. So I said, what happens if we exclude depreciation since it's a non-cash expense? And so removing depreciation from the present value analysis has a slight impact on the relative ranking. And what you can see is that when you take out the depreciation, the plant alternative is about $401 million, and the pipeline alternative is $419 million. I would argue that this comparison is interesting but moot because the PSC requires that you recover depreciation. And the reason why they require you to recover depreciation is they know everything you buy, you're going to have to replace. And I tell the story that I was one of the last humans on earth to buy a cell phone, and when I finally bought one, I got one of those Nokia ones that was as hard as a brick, and I said, I'll never buy another one. I got it. Not realizing that I was going to have to replace it every 3 years. But pipes have to be replaced, pumps have to be replaced, everything else. Okay, so first major conclusion. Based upon the assumptions used to develop and analyze the project alternatives, the difference between the present value cost over 40 years is negligible. When I first, came, when the model first produced these results, I had mixed feelings. On one hand, I thought, I couldn't have made it that close if I tried. But then on the other hand, I thought, perhaps it's not too much of a surprise since we're talking about the same volumes of water, same customers, same, geography and all that. And of course, went through and beat on the model and imposed upon all my professional colleagues and said, let's go through this and really beat on it to see if we could make a piece fall off or not. And we got it nailed down good. Now, again, we got to consider different assumptions though, okay? Because this is all based on the assumptions that I built the models around. But actual experience might differ substantially from those assumptions. So it's appropriate to consider how the projected results may change when different assumptions are used. This is often referred to as a sensitivity analysis. So the next portion of the presentation evaluates the results from 6 different sets of changes in certain assumptions. So let's consider those different assumptions. The first assumption is about the capital improvement project costs. The financial requirements for each of these alternatives pretty substantial. So we ask 2 questions. What if the project costs increase by 20%? What if the project costs are 20% less than what the engineers forecast? So with that, if the project costs increase by 20%, again, you see no relative difference between them. One is at 463 million, the other one's at 462 million gross, and then at 4% it's 195 and 196 million. If the project costs decrease, again, you see just the slightest amount of daylight between the numbers, but not particularly. At present value, 183 million versus 187 million. Second sensitivity analysis option is that we're assuming customer demand increases at 2.5% annually. What if the customer demand increases are double that? What if the customer demand increases by 2.5% for 20 years and then goes flat? And what if the customer demand does not increase at all? And so with that, if the demand increases by 5% annually, you see a more marked difference where the plant alternative becomes more expensive, 643 million versus 615 million. But when you bring it back to present value, the difference is less significant, 245 million versus 239 million. Okay. And again, present value is how much money would I need to have in my pocket right now to never have a water bill for the next 40 years. That's the present value. That's if the demand increases by 5% annually. If it increases by 2.5% for 20 years and then goes flat, again, it just doesn't nudge the numbers that much. And then the same, and this is where I think in your all's printout, this one I think is missing the heading, if demand does not increase, but again, demand, the volume of demand growth doesn't really nudge these numbers. So now we look at, okay, what if there's changes in the supplier rates? We're assuming that suppliers are going to increase their water rates at 3% a year. What if they increase them at 4.5% a year? What if they increase them at 6% a year? And so with that, this is one of the variables that does make a difference, is if instead of at 3%, it goes up to 4.5%, you can see the gross values are 530 million and 581 million, draws back closer to 212 million and 231 million, discounted at 4%. And then again, at 6%. And during my lifetime, a 6% water rate increase is really not that unusual. Gross amounts are 649 million, 768 million, but even discounted back to present value, it's 246 million and 286 million at 4%. I think that will probably be the biggest difference we'll see in any of these sensitivity analysis. The next is, what happens with water loss? Remember, I'm assuming that water demand goes up 2.5% a year and water loss demand goes up at 0%. So ask myself, or I ask the model, what if the water loss, instead of staying flat, goes up by 2% a year? Or what if the water loss decreases by 2% a year? If they have a robust flushing program or robust leak detection and leak repair program, they could decrease their water loss by 2%. And what you see is the model is not sensitive to those results. If it increases or if it decreases, they move together. Now, next one, and this one was a big issue for a lot of the citizens around the lake. And asking, what happens if there's changes in the curtailed withdrawal amount? So right now we're assuming that they would be curtailed to 500,000 gallons per day for 9.4 weeks a year. What if it was half of that? Or what if it was 50% more than that? What if the supply was only curtailed 4.7 weeks a year? What if it was curtailed 14.1 weeks a year? Okay, and what you can see here is, again, the models move together. The alternatives move together. Not much different. And again, even at 14 weeks. Okay? Next is, remember I said you've got 3 existing minimum purchase contracts. Each of those contracts have expiration dates on them. There's no reason that the new contracts have to be at the existing minimum purchase amounts. And so what I did is I said, let's look at what happens if you go under your existing minimums for 3 years and then you decrease the minimums by 50%, or what happens if the minimum purchase requirements go away after 3 years? And what you can see, again, is the models, if it decreases by 50%, the models don't move, or the alternatives don't move from one another. If it decreases by 100%. It changes the amount, but not relative to one another. Okay. All right, here's my conclusions and next steps. This is everything up until now has been interesting, in my opinion. This is crucial, okay? My conclusion, again, is based on the assumptions that I used to develop and analyze the project alternatives. The difference in the present value of cost over 40 years is negligible, okay? That's my conclusion. I've got 3 recommended next steps. The first is, because the costs have some sensitivity to change, it's going to be appropriate to document the basis for the assumptions, as that will likely be required during upcoming regulatory reviews of the project alternatives. As we present recommendations to the regulatory agencies, they're going to say, where did the 2.5% growth rate come from? Where did the 3% expense forecast come from? Where did the $4 million cash reserve come from? So on and so forth. We need to document the basis for each of those assumptions. The second is because there's nearly an endless number of alternatives to consider for each project assumption. It may be appropriate to identify further items to consider for sensitivity analysis. Remember, I did 6 sensitivity analysis scenarios. There may be others that you want to check. Third, because the difference in present value cost over 40 years is negligible, the final determination of which project alternative to pursue may be based on some criteria other than project cost. It may be appropriate to identify and evaluate the risks for each project alternative in order to determine which alternative best controls those risks so that you can achieve your project alternatives. Again, talking about the Cajun lady and me asking her for a haircut and her saying, "Mister, I know you're talking English, but I don't know what you just said." We've got 2 project alternatives. Each of those project alternatives has a design risk. How much risk is there in designing this? There is a construction risk. How much risk is there in constructing this? And designing it on budget, constructing it on budget and on time. And then the third is the operating risk. What's it take to operate this? So you've got 3 different risk scenarios. With that, you have to what I would recommend that you do is identify, your objective is to get a particular project designed, built, and operating on time and on budget. And then continue to operate it to meet your objectives over the lifetime. So with that, you can say, what could go wrong, and what are the triggers that would cause it to go wrong? And triggers could be anything from, spikes in construction costs, delays in regulatory approvals, things like that. Then you want to say, what is the probability of each of those triggers occurring? What's the development time? How fast do you see one of those project risk triggers occurring? When I talk about, if you imagine a project risk of weather disruption, you have tornadoes, hurricanes, and climate change. A tornado, you get minutes or hours notice. Hurricane, you get hours and days notice. And climate change, you get years of notice or decades of notice. And so with that, you have to, what's my probability something's going to occur? How fast will it occur if it does occur? And then what's the consequence of that risk? And once you have identified the risk triggers, probability, development time, and consequence, and then you say, okay, how am I going to manage these risks? The first way of managing it is, how am I going to prevent that risk from happening? What can I do to prevent it from happening? The second thing is, if it does happen, how will I know that it is happening? Because the worst risk is something that has happened and you don't even know that it's happening. And then the third set of controls is called the remediation controls. If it happens, what am I going to do about it? So what you do is you do the risk identification and risk assessment, and then you say, after I have done all of this, and I've got my controls in place, what project alternative leads me to the lowest set of residual risks, and determine, is that within my risk appetite? Because the thing is, there's nothing risk-free in the world. And so what's going to be the residual risk? And so with that, my advice is, it may be appropriate to spend about a month considering doing that. that risk identification, risk assessment. I'm not looking for more work, but this is something that I know how to do and have done before. That's it. That took about 40 minutes longer than I intended. And I'm sorry, but I hope it was interesting. I hope what you have seen is the district has said, we want a steely-eyed view of what these project alternatives are and what it's going to cost us. And what I believe that you have seen is a very, very rigorous model. The deliverables on this are three things. One is the PowerPoint presentation, which is the report. Then there is a printout of all the model. And then there is the model itself, which is a big honking Excel spreadsheet. And so with that, this has been in draft form, and I deliver it to you to receive it or accept it. And that takes it from being a work product delivered to you in draft form to something that constitutes an open record and it's available for consideration by your other stakeholders. So with that, I'm so grateful for your patience. I hope I haven't wore you out here right before the holidays. Hope it was kind of interesting, but what can I answer for you?
I do have one question. Thank you for this, by the way. It's very comprehensive. Is this a live mic?
I can hear you.
When you were part of the strategy that you did there as far as building the pipeline, that we would become contingent on being members of the Florence Water Commission. Did you do any analysis of that? Is it just kind of a up in the air sort of thing that would happen?
I did no analysis of that at all. Just said, if you did and you got water at their current cost, this is what it would cost you. I didn't do any type of feasibility assessment.
So in that, if that were to happen, my understanding is that there are some construction funds that would be built up in that situation as well. That's not part of this report.
That's not part of this analysis. All I said is to build the assets that you will need to build, the engineer's opinion of probable cost is X.
Okay.
No?
Thank you.
Anybody else have anything?
Let me just follow up on what you just said. Two of the most important things that Damon Talley, I'm an attorney that's representing Bullock Pen in front of the Public Service Commission right now. Mr. Miller made these assumptions based on information that was provided. One was build a water treatment plant, and the other was the pipeline, 12 miles or 13 miles of pipeline, something like that. But I think, and to me as an outsider, it's a coin toss. Assuming the assumptions for the pipeline and assuming the assumptions for the water treatment plant, the approvals and that sort of thing, it's a coin toss to me. But then you guys on the board have got to do due diligence. Can you become a member of Boone Florence Water District? Can Boone Florence provide the water that you're going to need, 2 million a day, I'm not sure exactly what it is, at the point 13 miles from here? And what is their cost, as you said, what is their cost going to be to make the improvements to get it to you? Do they have to build another line underneath the Ohio River to get it to you? And Boone Florence does not have a pipeline, to my knowledge, anywhere close to where your termination or the beginning point of this pipeline is. I think that's correct. So those things that somebody's got to check out. On the other side, building the water treatment plant, got to get the Fish and Wildlife approval to withdraw water. You got to get the Fish and Water approval for the plans and specifications. I'm not sure. I don't even know if it's been submitted or not. It's probably okay. And these engineers here can tell a whole lot more assumptions than I have. So either way, I think you got to do more homework. That's just my opinion, and so forth. But I'll shut up.
And
we talked about this water pipeline. One thing I think you're gonna have to show, and I think it would be misfeasance not to show it, is there's for a less than 3-mile pipeline to Northern Kentucky Water District along existing easements on 25. They considered only what you gave them, but we now have the model where you can take a look at that, plug the less than 3-mile pipeline along 25 to Northern Kentucky Water District, the actual cost from Northern Kentucky Water District, and compare it to anything else. And I think to not do that would be a disservice to every member of the Northern Kentucky Water District. You need to look at that.
Or Bullock Pen Water
Or
District.
Bullock, I'm sorry, Bullock Pen, not Northern, Bullock Pen Water District, no matter what, of which I'm a member. Thank you for your correction on that. Although, I think if you look at the growth rates, one thing that is perhaps also not considered in this model, that infrastructure line, that 2.5% growth is gonna require additional infrastructure in the line to provide it. That 2.5% growth isn't gonna come along the existing distribution lines. When you bring that pipeline along here, likely to support the 2.5% growth, you're gonna have to build that pipeline anyway through those areas. Down 42, down 14 to here, down 25. Those areas are likely where your 2.5% growth is gonna come, certainly in the near front, and that distribution pipeline is likely gonna have to be built anyway.
And the way I address that is that any growth that required new distribution lane would be paid for by the new customers. The growth would pay for growth, and the growth wouldn't be subsidized off the existing customer base. Mr. Chairman, if y'all don't have any other questions, may I take questions from the audience?
Yeah, they have it.
I do. Okay, I have one, because you did this study for 2024 analysis, right?
At 2024 as the test year.
Okay, and then you got to the slide about the Bullock Pen Lake, and you said that that's where everybody was, can you hear me?
No, I can hear you.
Oh, okay. You know, kind of anxious about withdrawing water. But you used 500,000 gallons of water. You didn't use the projected of 1.1 million gallons.
Right, I said it, because if they were limited on that curtailed limit, that's what would come out of the plant, or come into the plant and out of the plant, and everything else would have to be purchased.
Okay.
Okay?
Okay, I just wanted to make sure that was clear,
Yeah.
because,
Why did you use the number 500,000?
Because that's the number that tentatively the Department of Fish and Wildlife has said. That at the normal levels of the lake, they could take 1,500,000 until it got down to a particular level. And then once it got to that particular level, their withdrawal limit would be 500,000 gallons per day.
But sir, what's the amount that the Bullock Pen board members want to withdraw from the lake?
I didn't really get into, I mean, it's discussed in there that they would like to raise it up to 750,000. But the fact of the matter is, you only get to use what your permit says you can use.
Sure, I understand.
Yeah, and so with that, right now, there's not a contract or a permit in place, but if there was, right now, the tentative agreement is around the curtailed limit of 500,000 gallons per day.
But would you agree then that if the limit were changed to 1 million or 700, that suddenly the models would begin to separate?
I have not modeled that. That can be put in there, and it literally takes minutes to make that type of thing.
Sure.
That wasn't one of the sensitivity analysis, because I can offer opinions on inflation rates and demand rates.
Sure.
I can't really, because that's been my bread and butter for 40-something years. Permit limits, I use what they tell me.
Right.
Okay?
Well, when you're a homeowner on the edge of the lake in question,
Right.
You have certain feelings that may not match up with your charts.
Let's talk about that. What I always tell people is in a project like this, that you want to influence, it's, how do you wrestle that bear? And the way you wrestle that bear on that issue is at the permitting process. And that's where you focus your energy and your efforts.
So that permit's gonna hold their feet over the fire, in other words.
I wouldn't say that it holds their feet to the fire, it's just literally a gatekeeper thing. You can use up to, on a regular day, you can use up to 1,500,000, not a drop more. On a curtailed day, you can use up to 500,000, not a drop more. That's the whole thing about permits.
Okay.
Thank you.
So question, hey, I appreciate the model. This is a question about how flexible the model is, if it could consider it. So I just mentioned the Northern Kentucky Water District 3-mile extension. Is it easy to modify the model to take that extension into, consideration? Is that?
My grandchildren would say it's easy peasy lemon breezy.
Okay, good, I think so. So, second question about the model. Built into the Boone-Florence Water Commission rate is the storage cost is built into that. They provide storage costs. And we know with a 2.5% growth, your water storage is gonna be really a factor of the demand. And so, how would we accommodate your model to build in the water storage that would not have to be paid for by Bullock Pen because it's already embedded into Boone-Florence Water Commission rates? Can your model consider that?
My model can use whatever the opinion of probable cost from the engineers is.
That is not what they told us. They told us when we talked to them that they would supply to that point, we would pay to that point, but it would be up to us for all the pipelines and storage tanks and everything else. Now
The point is, you would pay for.
Their agreement with Florence and Union and Burlington is different than the agreement they would want to make with us.
Yeah, well, you haven't had the agreement, you haven't seriously, and everybody knows my family is gonna pay for the cost of the pipeline. But I'm talking about the future growth, not the pipeline cost. The future growth, that $3.68 would defer future costs for my kids, your grandkids, cost of storage. Okay, that is built already into their model for the future. And so they're not gonna pay to build the pipeline. But their cost builds in the cost of future water storage considerations.
Any other questions? Thank you all for your patience. Thank you for this privilege.
Thank you.
I'm grateful, I'm honored to be here, and would be glad to help further if I can.
We will be in touch.
Thank you, sir.